Hello, hello. Good morning, good afternoon, everyone, depending on where and when you're joining us. My name is Courtney Drake with Avalara. I'll be your moderator for today's session. So it's hard to believe, but 2025 is upon us, and so are new tax changes. And so we have brought in a couple of tax experts from KPMG and Avalara who are here to spotlight the tax trends that they're seeing and also the pending legislation that could impact your compliance obligations in the new year. Before we dive in, though, just a few friendly reminders from me. First off, usually our webinars are 1 hour long, but knowing how many questions we get during these presentations, we have decided to extend the time past 60 minutes to allow more time to answer your questions. So if you're able to join us past the hour mark, please feel free to do so, and we'll get through as many questions as we can. Also, if you've attended a webinar in the past, you'll know that we record all of our presentations. So if you would like to listen to it again or even share it with a colleague, keep an eye on your email inboxes for the link to the recording, which we usually share in the next 24 hours. And then I also wanted to review this orange webinar console that we're looking at. It's not orange anymore. I think it's blue for the holidays, but how you can interact with us today. First and foremost, there is a Q&A box in the middle directly underneath the video feed. So you can use that box to submit your questions for myself or our speakers at any point over the next hour or longer. Like I said, we will be responding to questions and have time for live Q&A throughout the presentations, but I have a few of my team on the back end to join to respond to questions individually as well. And there is also a community chat on your console. If for some reason you're not seeing it, go ahead and refresh your screen and it should be there. But if you'll down at the bottom of your screen, you'll see there are a couple of icons that look like chat bubbles or text bubbles. So go ahead and click on that and that will make the attendee chat pop up. If it is too distracting at any point during the presentation, you can also minimize it to keep your focus on the presentation and our speakers, but that's available to you as well if you'd like to interact with your fellow webinar attendees. Go ahead if you'd like to and introduce yourself and let us know where you're joining from. I'm dialing in from my home office, but I'm in Seattle. All right, and then finally, we do have some related resources and links available on the console if you're interested in learning more about any of the topics that we're discussing today. All of those links will open up in a new tab and be waiting for you once the webinar is over. And then that is also where you can download your own copy of today's slides if you'd like to save them for later reference, or just get a sneak peek of all of the topics that we're going to be covering today. I also wanted to highlight that we do have some additional links available in the slides themselves about some of the legislation that we're talking about. So I would recommend downloading those slides and saving them for later reference if you want to get access to those links. And then as many of you have already found, we do have the ability for you to add reactions. So down at the bottom of your screen, you'll see a little emoji face. So you can click on that and choose from the available reactions and let us know what you're thinking and what you're feeling. All right, let's go ahead and move forward. Just a quick disclaimer that Avalara cannot provide legal tax advice. As always, we do our best to answer your questions as best as we can. But if you do submit a question and it's very specific, we will not be able to answer that. So keep that in mind when you're submitting your questions. And also a reminder, we are offering 1 hour of CPE credit for today's presentation. So for those looking for CPE credit, note that you will need to respond to 3 out of our 4 poll questions, and you'll also need to view the webinar for at least 50 minutes. That's 50 minutes. And once you've met both of those eligibility requirements, your individual certificate will appear on the console in the Earn Certification box, and you can access it there. Okay, let's go ahead and meet our presenters today. So like I said, we have experts from both KPMG and Avalara with us. First up is Audra Mitchell. She is the Tax Managing Director of KPMG's Washington National Tax Practice. Audra, it's great to have you here. Do you want to take a minute and introduce yourself?
Sure. Thank you, Courtney. I'm going to say good morning because I'm sitting in Kansas City. Happy to be here today, joining on this topic. As mentioned, I'm a managing director in KPMG's Washington National Tax Practice. My focus is on state and local indirect taxes. I lead our SALT communications industry team and also our KPMG indirect tax controversy practice. So I really focus on all things impacting the indirect tax space, and have been doing this, I don't like to say that, but I'll say it, almost 30 years. So
Be proud of all of that experience.
yep.
Awesome. Well, thank you so much, Audra. It's great to have you here. And then we also have my colleague, Scott Peterson, joining us. He is the Vice President of Government Relations and U.S. Tax Policy here at Avalara. He's been on many a webinar, and it's always great to have him with us. Scott, you want to say a quick hello?
Hi, thank you, Courtney. Welcome, everybody. I too am going to say good morning because it's morning here where I am in Nashville, Tennessee, and we're thrilled to have Audra with us today. This is a big deal for Avalara to have KPMG presenting with us. We're thrilled with our partnership with them, and we're very happy with the expertise that you're going to hear today.
Absolutely. All right, thank you, Scott. And speaking of expertise, so let's review the agenda and some of the things that we're going to be discussing today. So you can't have a tax changes webinar without talking about economic nexus, and there have been some new developments with thresholds there and how some states are looking to simplify economic nexus. So we'll start everything off with that. Then we'll move into some movers and shakers on the 2024 ballot, some of the things that passed or maybe did not pass that are noteworthy. Then we'll take a look at retail delivery fees and some of the states that might be considering them in the future. Then we'll dive into taxation on digital goods and streamings and some things that are going on in that arena. Then we'll dive into EV tax credits and how some states are actually moving to end them. And then we'll top things off looking at worldwide taxation and some of the new e-invoicing mandates that are coming out from different countries. And then, like I said, we'll dive into Q&A at the end of that. But before we dive in, I do promise this is the last slide for me, but we have our first CPE poll question up. So we'll leave this up for a few seconds, but if you're interested in CPE, make sure you get your response in. We would love to know what has been the most challenging aspect of managing tax compliance for your company in 2024. And for this one, you should be able to select more than one. So we'll give folks a few seconds to respond, and then we'll move forward. For this one, we're not going to look at results. So just let us know what you think, and then we'll move forward.
So I'm going to take this chance. We had someone ask us whether or not there's going to be anything in the slide deck about Canada. And unfortunately, I apologize. I honestly don't know much about Canadian taxes. I know a lot about this Canadian sales tax holiday that just started on Saturday. Unfortunately, that happened after we were able to after the slide deck was done. So we couldn't add anything into the slide deck about the Canadian sales tax holiday. I don't know, Audra, if you do any practice with Canada. I know KPMG's got a very robust Canadian tax practice.
Yeah, fortunately, there's experts in Canada and in the U.S. who focus on Canada. So I do not have experience in that area.
Yeah. So we're sorry if this is going to be mostly a U.S. issue.
Yeah.
I will talk a little bit about e-invoicing outside of, but that's a Europe, Central and South America, and the rest of the world.
Yeah. I will say, I know that we just published a blog on the new Canadian tax holiday. So if you're interested in learning more about that, you can head over to just avalara.com and then click on blog. And it's actually one of the newest blogs that we published. So if you want to learn more about it, you can do so there. All right. Well, thank you, everyone who's responded to this question. Let's go ahead and dive in. So like I said, we're going to start off with economic nexus. And Scott, I'm going to hand it over to you.
Thank you. The change that the economic nexus has been around with us now, 5 years, 6 years, going on 6 years. And what frustrates me a little bit is that there hasn't been more change in economic nexus. I thought there would be a lot of evaluation and second guessing by the state legislators and departments of revenue on how the process was working for them. The one thing that we have seen them actually give a second thought to is the 200 transaction component of economic nexus. You may not remember this, but the world of economic nexus for state sales tax started because of what South Dakota did. And it was a, kind of a shot across the bow to the Supreme Court to get the Supreme Court to take another look at what was originally the Quill versus Bellis Hess case in 1967, and then Quill versus North Dakota in 92. Every state adopted what South Dakota adopted, except the ones that adopted it several months after South Dakota won the case in 2018. So we had all these states that had this exact same economic nexus threshold, $100,000 in sales or 200 separate transactions. And the legal and economic logic behind the 200 transactions was lost very quickly. South Dakota had something in their mind when they put that in their statute. It was very specific to them, and everybody else adopted it. And what everybody's realized since then is that 200 transactions creates really, really odd outcomes, very much so like physical presence used to create, which is you end up having people with a sales tax collection holiday in a state, or sales tax collection obligation in a state where they honestly had very little economic activity. So what we've seen since then is a number of states repealing the 200 threshold. And so this year we had Indiana, Wyoming, Alaska, we expect New Jersey to do so. They haven't done it yet, but we certainly expect them to do that. And there'll be more states that do that in the future. If you look at a map of economic nexus, you'll see the overwhelming majority of states that have economic nexus are streamlined sales tax states. And the streamlined sales taxes, the organization itself has taken a position that the thresholds shouldn't be part of economic nexus. And so we'll see more states do that as well. We have Alaska on here, and you're probably asking yourself, Alaska doesn't have a sales tax, so why are you having that in here? Well, the cities in boroughs of Alaska, borough is a word that they use up there to represent effectively counties, is those 110 local governments in Alaska that have a sales tax took it upon themselves to create a Department of Revenue. State Department of Revenue would administer local taxes. The local governments don't want the state to administer their taxes. So they created an entity that is headquartered inside the Alaska Municipal League. And so as far as I know, this is the only example maybe in the whole world of effectively a privately run Department of Revenue. Given that run through an organization that's not the government, it is nonprofit, but it's not for profit, so what they do is they administer these local taxes. All of those local governments in Alaska that are members of this, and there's a few that aren't, adopted an ordinance that's exactly like South Dakota's economic nexus law. And this year they adopted another ordinance that eliminates that 200 sales threshold from their economic nexus analysis. So we include Alaska in here because all those local governments that are members of the Remote Sellers Commission in Alaska have amended their economic nexus ordinance to exclude the 200 transactions. You can see this is the map today. And I wish we had an hour to go through each of these states individually and explain why this map doesn't begin to describe the complexity associated with economic nexus. The old days when the only way you could be required to collect a state sales tax was to show up. You actually made a conscious decision that gave that state the expectation that you knew what you were doing and that you planned on moving into their state. You planned to open a store. I don't think anybody opens a store without planning. You may have a shipment go into that state in your own vehicles that you hadn't planned on, but that's clearly you had an expectation that you were going to do business in a state when physical presence was the test. And the states had the right then, or felt they had the right, to assume that you knew what you were doing, which I don't think is an unreasonable expectation on their part. It doesn't always turn out that way. Economic nexus is entirely different. So, and let me finish. So when you do that, you walk into that state knowing, okay, this state sales tax rate is X. They have local governments that have a sales tax rate. The state sales tax base is identical to the local sales tax base, or it's not. This is where they're different. I know I'm going to have a local business license wherever I open a store. You have done some research. You know what you're going to have as for tax obligations. Economic nexus changes that. It changes that in the sense that it's not your decision. It's your customer's decision. So today, your customers decide where you're going to have an economic nexus and where you're going to have a tax obligation, which means you may not know when you start the year, and certainly when 2018 was and economic nexus became a thing, I don't think anybody realized that next sale they made to that next person in South Dakota was going to create economic nexus for them and an obligation to have a sales tax license and to collect sales tax. What we have since learned, which honestly most of us already knew, was that this map barely touches the surface. South Dakota and North Dakota both have exactly the same economic nexus threshold, $100,000 in sales. There's a big difference between the two sales. South Dakota is a gross receipt state. North Dakota is a taxable sales state. South Dakota, you get to $100,000 in gross receipts long before you get to $100,000 in taxable sales in North Dakota, even if you're selling the same exact thing to exactly the same type of customer in those two states. In addition, South Dakota taxes everything. So software, services, everything is taxable in South Dakota. Almost no services are taxable in North Dakota. North Dakota has a very broad exemption for nonprofits. South Dakota has a very strict, narrow exemption for nonprofits. If your customer is the Catholic Church, you're going to collect tax in South Dakota and you won't in North Dakota. To add to the irony is that those two state sales tax were written by the same person in the same year in the 1930s. You look at those two states' laws, they are literally identical. And then over time, they've slowly diverged from where they both started at the same time. It's so when you look at this map, don't think this is all you have to worry about. You have to worry about a lot more. What's taxable? What isn't taxable? Who's taxable? Who isn't taxable? Is it a gross receipts tax? Don't call Hawaii and ask them to talk. Don't call Hawaii and ask to talk about their sales tax. They don't have a sales tax, and they'll let you dangle on the phone until they finally feel sorry for you and tell you, no, we don't have a sales tax. So don't be surprised if what you learn the next time you realize you have economic nexus is that this state's different than the state I'm in. So Audra, let's talk about movers and shakers on the 2024 ballot.
All right, thanks. And one thing I did want to touch on really quick to your point there, Scott, is that also make sure that when you're thinking about nexus, a lot of times that only applies to sales taxes, those rules. Like I mentioned, I do work a lot of work in the communications industry. A lot of those additional communications taxes, those nexus, economic nexus thresholds don't apply. Sometimes it's because they deem you to have physical presence in the state right away. If you're using the network of another carrier in the state or your own network. So, I've seen clients think that, those thresholds apply to any tax in the state, and the law is not clear that that's the case. A few extend it past sales tax, but a lot is just the sales tax. And moving on to the 2024 ballot issue updates, it's funny when you look at this slide and look at the headlines, it looks like people really like taxes. A property tax elimination got voted down. People voted to keep a property tax. People voted to increase a tax, not reduce a tax. I was looking at these headlines and thinking, you really have to dig into what was behind these ballot measures to understand the outcome. Otherwise, you kind of scratch your head thinking, wow, people voted to increase taxes, not eliminate taxes. What happened in 2024. Diving in then, in North Dakota, As I mentioned, taxpayers rejected a property tax bill that would have eliminated the property tax. And again, what's behind that? Because nobody likes property tax. Nobody likes it. Many people ran this year in state elections, promising to reduce or eliminate property tax. Here it goes to the voters, and the voters reject the elimination. Well, behind this, you had a lot of firefighters, police officers, and teachers saying, hey, we need to get paid. We can't operate. There was no mechanism in place to provide additional funding if, this property tax went away in North Dakota. So you have things that people care about, public safety and education, that were going to be seriously impacted if this tax went away. Does that mean they like the tax? No. Does that mean they think it's set up correctly? No. But in what they were doing, they hope that, the state legislature will now look at reform and do it, responsibly, whereby any property tax reductions, still make sure that those types of services that residential people and businesses care about are still in place. Oregon has tried to have a lot of ballot measures whereby there would be an increase in taxes on corporations in the state. Usually that's popular, but I think voters are starting to realize an increase of taxes on businesses in the state flows back through to me. I think there was a time period where a lot of times people, didn't necessarily see that. They were like, oh, that's great if the companies pay taxes, it'll reduce my taxes. They're the ones who should be paying the taxes. But I think, voters are starting to see eventually that flows back through in additional costs or things like that. And this one in Oregon was a little bit unique because it was going to be a minimum tax on companies' gross sales. And then a rebate of that tax would go back to all the individuals in the state. It was one of those things, I don't know if they looked at compliance of that system. I don't think it would have been dollar for dollar, but, so voters, in this instance, I think saw there are complexities here. We don't know if it'll actually work out the way it's intended, and that measure failed. Similarly, in South Dakota, there was a measure to reduce taxes on groceries. And again, that failed. Looking down deeper into it, though, again, it wasn't a message, hey, we like taxes, tax us more. It was just looking at the ballot measure talked about an elimination of taxes on items for human consumption. And as the voters were looking into that and, as it was explained to the voters and put out to them, this looked like it would go way beyond just food. It may exempt other items which could significantly impact the fiscal, state of South Dakota. And again, it's one of those where voters are hoping that the legislature looks at this, clarifies that it's a reduction in tax on food and, does it legislatively in a manner that won't impact the state in quite as big of a fiscal manner. And then in the Nashville area, Davidson County, sales tax rate increase of 0.5% was approved. And again, this was because this increase is designated to improve transit. So smart cameras, roads, bridges, anything and everything like that, which again, that infrastructure is usually significant to an area. Those are areas that I see, sales tax increases frequently get approved, and it was approved in the most recent election cycle.
Yes, yesterday I had to go to pick up some kittens at a veterinarian's clinic. That was 17 miles from my house. I live in Nashville, and I voted for this tax increase. 17 miles from my house to the veterinarian, round trip, 2 hours and 1 minute. Wow. Traffic is insane here.
Yeah.
Anything. I would have gladly voted for a tax increase if they couldn't do anything to minimize the traffic here in Nashville.
Yeah, Nashville grew fast, and unfortunately, what comes along with these tax increases is road construction. But we can all bear with that to get the improvements of like you said, decrease time, increase safety, all those sorts of things. It's supposed to lead towards bus systems and things like that. So, definitely something that voters approve there. So I will let Scott talk specifically to Louisiana.
Oh,
they were busy.
they were busy, and they, they've been talking. The governors from Louisiana have been talking about tax reform for so long that I think a lot of people, and they've historically struggled to be successful, which is a very polite way of saying they failed. But they shocked everybody this year. It certainly shocked me. I almost stopped paying attention, and which was a bad thing, because they did what a lot of state legislatures like to do, which is draft legislation on the fly and do so in the heat of the legislative session. My first job was working for a state legislature, and it's frightening what you can accomplish or see get done on the last minute of the last day of a legislative session. Louisiana had a fiscal cliff coming. Several years ago, they raised their sales tax because their budget was in trouble, and it was set to expire on June 30th of 2025. And their budget was again in trouble, and there was no way they were going to be able to balance their budget if they allowed the sales tax to go back to its original amount in the middle of next year. At the same time, like I said, the governors in Louisiana have wanted to do some tax reform for a long time. And so this was the opportunity that, the legislators and the governor of Louisiana used to create something big. The old saying in state legislatures is never let a crisis go to waste. So what they did is they've been trying to reduce the personal income tax. They've been trying to reduce the corporate income tax. They want to get rid of their franchise tax. And the goal has always been to broaden the sales tax to all services, and then to use that money to offset the taxes that they don't like. They're trying to compete with Texas, in Tennessee, they don't have income taxes for the most part, and rely on sales taxes. Louisiana has an advantage over states like Tennessee because they have lots of oil and gas, like Texas does. So what they've done is they've made significant changes and I'm not an income tax person, so I'm not going to. Audra can talk about that if she wants to. But the things that really impact Avalara are the addition of digital products to the sales tax base, effective January 1 of 2025, an increase in the sales tax rate to 5%, effective January 1, 2025, a requirement that every parish plus the parish e-file system revamp their sales tax returns to account for certain things that the legislature wants to know. So there's a number of things that are exempt at the state level that are taxable at the local level in Louisiana, and the state doesn't like that. They want the same exact tax base, state and local. And they did some of those changes this year, but there were a couple big ones that they didn't, and it was because the local government said the cost of the exemption to them would be too great. So what the legislature is requiring them to do is to start getting you to tell the local governments how much sales tax you're collecting on manufacturing equipment, on certain prescription drugs and medical devices. So all the local returns are going to change. They're supposed to be done by the end of this month. It's not likely they'll meet that deadline, but they certainly have to be done by the end of January, so you can file your January return in February. They've eliminated, and they tell us they did this inadvertently, but they have eliminated the local vendor compensation. Before, there was a state vendor comp and a local vendor comp. The legislature repealed all the vendor compensation language. When they reenacted it, they left out the locals. So there is no local vendor compensation starting January 1. And they've limited the state portion It was a maximum of $1,500 a month. Now it's $750 a month. So no vendor comp at the local level, a reduced vendor comp at the state level. Digital products are going to be taxable, and you should go to Avalara's blog and look for Gail Cole has written a really good article on the digital products that have become taxable in Louisiana. And all the tax returns are going to change. So if you've got those hard coded, you're going to need to change them. And the tax rate went up. Plus all kinds of other stuff, more than we have time for today. So Audra, I know that was brief on Louisiana, folks, and I apologize for that. It is a much bigger change than I thought they would actually accomplish. So it's something to pay attention to. Let's talk about retail delivery fees.
All right. And, the Colorado and Minnesota retail delivery fees have been in place for a while now. The thing I've been impressed about here is that Colorado and Minnesota have both been listening to businesses in this instance and have made changes, to, look at, okay, what is working, what is not working, and, made modifications. A lot of times you see some new type of fee like this go into effect and everybody's just got to live with it, whether it works or not. So during the year, some changes were made to, either increase the amount of revenue that a business has to make before they're subject to the retail delivery fee, or, initially these laws were pretty clear on how it had to be passed through and things like that. And I think the administrative burden of doing some of that things, I know, billing systems aren't necessarily that nimble. There's limitations on the number of taxes and fees you can put on a bill or an invoice, how you can do it, if it's percentage based or per line. And so now, there can be an option to pay it out of pocket, not necessarily collect it from others. So, those are moving forward. And as is always the case, if other states see something that they think might be working, why not jump on the bandwagon and fund, come up with a similar fee yourselves. And again, kind of similar to the tax increase that was approved in Tennessee, a lot of these retail delivery fees, the intended purpose, most of the states say, is to improve transit, improve the roads, replace lost money from gas taxes if people aren't driving as much or things like that. So, jurisdictions are really looking at these, retail delivery fees being considered in, states like Maryland, Nebraska, Nevada, New York, Ohio, and Washington. And it's interesting because I've seen a lot more studies of whether these delivery fees make sense than I've seen necessarily for other taxes or fees where cities or states implement them and just implement them quickly. The Washington study really looked at what Colorado and Minnesota did, what worked for consumers or didn't work for consumers, what did or didn't work for businesses. And they're really taking all that into account. Oftentimes they're finding exemptions work if it's for delivery of groceries or prescriptions, things that they think people might really need, but maybe can't get out to get. They're estimating the number of deliveries and looking at, okay, this might cost people $14 to $15 a year. I think a lot of people have gotten into, online ordering and delivering to your house since COVID and found out it was so convenient. That didn't go away. So that estimation based on an estimated delivery fee of 30 cents per delivery in Washington seemed kind of low. But they're really, studying this more than I think I've seen in other jurisdictions for other taxes or fees that may have impacted consumers or retailers, at a much higher rate. But the Washington study is looking at, okay, what would it mean to the state if this were implemented January 1st of 2026? So it was also studied in Ohio and Nevada. Bill, was live in New York. So if I had to predict something that I think will move forward in 2025, I think we'll start to see more of these retail delivery fees. Again, the purpose stated to fund transit is usually something that gets approved by voters for sales tax purposes. So I think it's a fee that they can implement, that they don't think will have too big of an impact on business or consumer, and that's, you know, in the public interest.
Awesome. Well, thank you. We have our second poll question appearing on the screen right now. It should be in the same window where the slides are appearing, so you should see it there. But we're curious to know how or have retail delivery fees impacted your business in 2024? So we have yes, no, and if you don't know, that's okay too. You can add that in there, but we'll leave this up for a few seconds, allow people time to respond. We've gotten a ton of great questions. I'm trying to look through and find some. I know that there were a few going back to economic nexus, where people were curious with states that are looking to remove the transaction threshold. If they're already filing in those states, does that mean that they can stop filing if they don't meet that transaction threshold, or what should they be doing?
So that is the right answer. One should get some professional advice on the timing of that. But yes, if you're collecting, and this is what the states have said, if someone is collecting their tax today because they've exceeded the 200 transaction portion of economic nexus and not the sales portion of it, the expectation is that you don't have to continue to collect their tax, but you should be very, very thoughtful on the timing of that.
Yep. Okay. I'm just looking through a few of these other questions. And we'll have time later to get more in depth with some of these. But it looks like we've had a majority of folks respond to this one. So with this one, we are going to take a look at the results. So let's see what people have said. So it looks like almost 60% have said that they have not been impacted by retail delivery fees, but over 25% said that they have. And as we see maybe more states imposing these, it will be interesting to see how this changes over the years. Scott or Audra, are there any call outs from you after looking at this?
The only thing I would note is that with the, so many people are saying, no, they haven't been impacted. Make sure you're in the loop with your retail and marketing teams, because that's one of the things that's so important to have tax aligned with those teams, in case they're thinking about, hey, this delivery that our competitors is doing is really popular. We should do that. Mm-hmm. Make sure that if they decide to do that, in advance, because it can take some time to implement these in the system. It's not as easy as flipping a switch like the taxing jurisdictions think. And then, also make sure that in their decisions, they realize, what the impacts could be to the consumer. It could be, an increased cost to the consumer or to the business. So, that's true in any kind of tax or fees. Stay aligned with your marketing. You don't want to hear about it on TV for the first time or radio for the first time. But be sure and educate those teams on, these types of taxes and fees that could arise if they, change the business plan or model.
Yeah. Yeah, that should be something that we all have a plaque that sits on our wall. You will not hear about our tax problems on the front page of the newspaper.
Yep.
So there was a question for SST states, can the retail delivery fee be filed through SST? Well, fortunately, we only have one, that's Minnesota. And Minnesota has specifically, they've changed their process so that it is possible for Avalara to remit the retail delivery fee in Minnesota through SST. Can't promise you that's the kind of thing that would happen if some other SST state did that, but so far it's a positive thing.
All right, well, thank you, everyone.
Oh, I'm sorry, that was me.
Go right ahead.
Let's talk about digital goods and streaming.
All right, always a popular topic here, and states definitely like to look to the new technologies. Again, I guess some of these aren't as new anymore, but definitely sources of revenue that the jurisdictions, want to make sure that they're maximizing to the extent they can. Going all the way back to 2016, the cities in California started making announcements, and it started with Pasadena and a few other cities making announcements in 2016, issuing policy statements that they would intend to start applying their utility user tax to include streaming services. much of the industry was very surprised by that, and there was a lot of pushback. And eventually, those cities pulled back that guidance and said, wait, we're going to look at this, we're going to study this before we make an official decision. Now, these utility user taxes in the California cities are pretty high rates, 5 to 10% in many instances, and they really vary by city. Some cities have a specific video users tax. Other cities were trying to say that the broad language of their communications users tax, where it talks about the transmission of video in the communication services definition, was enough to pull in video and streaming services. And so this is really a city by city question, which makes it even more complex. Then again, layer on the fact that these cities have to get voter approval to pass this tax language. And there's questions about whether, when a consumer voted to, approve a communication users tax that included video, did they realize at that time that years later that could pull in a streaming type of service? Is that voter approval from the consumers really met? So there's all kinds of complexities going on in the cities in California related to whether streaming services are subject to the tax or fee. I think it varies by city, and again, by their ordinance, what I've seen companies doing in this space. But there are some companies that, when they were approached by the cities about this, said, this just doesn't apply. And there has been litigation ongoing as to whether the various local utility user taxes or fees in the California cities applies to streaming. Just recently here, there was a decision that came down in the city of Santa Barbara versus Disney case related to Disney's streaming services and whether they were subject to the taxes or fees. And the decision was in favor of the city. Now, Santa Barbara has a very specific video users tax. They weren't trying to do this under their communications users tax. And the definition of video supplier and video services in that tax is broad. It doesn't specifically mention streaming or, some of those issues, but it is a broad tax. However, I think other cities will be emboldened by this opinion and not necessarily look at the language in that and use this decision to try, and apply the tax in areas, where the language is smaller. It's supposed to apply to telecommunications companies, not video service suppliers, and so I think that the uncertainty in California is going to continue. I don't think that this decision is going to answer the question that many people thought it would. And there's also other challenges. Is it a discriminatory tax in violation of the Internet Tax Freedom Act? The Internet Tax Freedom Act says if you don't tax something, not sold over the internet, you can't tax the digital version of it that's sold over the internet. So there could be discrimination issues. The California cities made it clear to companies that they were watching the litigation that went on for a while in the city of Chicago, when Chicago tried to apply their amusement tax to these types of services. And when Chicago won the Internet Tax Freedom Act question for purposes of their amusement tax and the application of it to streaming services, it really made the cities in California feel that their argument was strengthened against the Internet Tax Freedom Act issue. That may or may not be the case, but they felt emboldened by it, so much so that they started, they've been sending out notices for years to companies saying, hey, we think you should be, remitting tax on these services. They're sending questionnaires to companies. We get questions all the time from companies. Hey, I get this questionnaire, about this application of this user's tax to my services. And again, there's no one set answer on whether these do or do not apply. Again, it varies by city. There could be legal challenges, even if the language appears. Was it properly voter approved? And I think many had been hoping that this case might help resolve some of the issues, but I think it's going to keep on going due to the variances across cities. And again, Massachusetts and New York have both introduced bills in 2024 to tax streaming. So it's something many of the states are looking at. These revenue sources are popular. In some jurisdictions, Florida, for example, video streaming is subject to the communication services tax, not the sales tax. And they've been issuing opinions this year, pulling in items like, smaller, where someone purchases athlete wishing someone happy birthday. That's a pretty short video message, but anything that includes video, Florida is taking the position, is covered under their communication services tax. Some of these decisions may not take into account the broad definition of internet access in the Internet Tax Freedom Act. Internet access per the Internet Tax Freedom Act includes email, personal electronic storage, video clips, instant messaging, and things like that. Unfortunately, those services are not defined. What is a video clip in the definition of internet access is not defined. So there could be, litigation going forward as to whether some of these jurisdictions can tax certain types of video. How long can a video be and still be considered a clip? So to the extent, looking at what the states are doing across the board, if I move on to the next slide, some are taxing streaming as a digital good. Some, and again, like I said, some are taxing it, as a video or a cable service. In Texas, it's classified an amusement service, but it's subject to the sales tax as an amusement service versus, as I mentioned, in Chicago, it's actually subject to the amusement tax. So streaming is one of those services that's getting pulled into numerous different taxes, numerous different ways. Sometimes it matters whether it's downloaded or, purchased for continued use. Sometimes it doesn't. So, those facts matter. And again, it's going to be a state-by-state basis. As was mentioned, Louisiana is now, starting to tax digital goods and not giving people much time to get that into place starting January 1st of 2025. Michigan has come out with guidance that an NFT, if it represents ownership or interest in tangible personal property, is taxable. And I should say, for those who aren't familiar with the acronym, an NFT is a non-fungible token. Michigan doesn't tax digital products, but they do feel like an NFT should be taxable if it represents, ownership in intangible personal property. Georgia started taxing digital products on January 1st of this 2024. So that does not seem new. However, they took their time to put out regulations on how that tax should apply, how it should work. And those regulations were actually subject to a hearing on December 19th, 2024. So comments could be made there. So we'll wait and see how that plays out, and what final recommendations are on, how Georgia has intended the tax to apply since January 1st of 2024. And then Vermont, I think, surprised some people, including pre-written computer software like SAS, in their definition of tangible personal property effective July 1st of 2024. So definitely an area that, jurisdictions are looking at for revenues. They kind of started during COVID when video streaming became even more popular. So stay on your toes in those areas, and they're trying to tax it one way or another, it seems like. So moving on to the electric vehicle taxing, we'll pass that back to Scott.
Scott, you might be on mute. We don't hear you.
Scott was on mute. Thank you very much. Appreciate that. I think the message that seems to be percolating through state legislatures and in Congress is that electric vehicle tax credits were a nice thing, but that they're probably going to go away. Now, some of this is related to the way we fund highways. and we have, and Audra, talked about the retail delivery fees, RDS. The way we fund highways is broken, and it needs to be changed, and no one really knows what to do. And some of the things we're seeing in changes in the EV tax credits is related to that. We need to raise money. We need to have money to fix our highways. You're using our highways. Why should I give you a credit to buy something, tax credit, that I don't give to somebody else? And when you're using the highways every bit as much as somebody else, and you're not buying gasoline. So we should expect these, honestly, to go away or to become much more infrequent and smaller as time goes on. Let's do another poll.
Phew, that came up fast. All right,
Sorry.
our third. No, not at all. That was good. We have our third CPE polling question up on the screen. Has your business had to make any changes to your finance team processes to account for tax changes that went into effect in 2024? So again, we'll leave this up on the screen for a few minutes. One question that I'm looking at right now that came in regards to Louisiana. So it sounds like Louisiana may have already taxed digital products before this recent ruling. Is that correct or no? Did they extend it maybe to new products?
Well, they've always had a conversation about software, and honestly, I'm not close enough to remember exactly what they did. I saw the question too. I don't know the answer. Okay,
no problem. I know that I just put in there a list of the new products that they extended sales tax to, and that's including digital audio visual works, digital books, digital codes, digital applications and games, digital periodicals and discussion forums. So it might have been that they just solidified that list of what was taxable. And then another question, Scott, I saw you responded to this one, but I thought it might be good for the broader group as well. So if you meet the Alaska economic nexus threshold statewide, does that mean that you've also automatically met it in the individual cities as well?
That is their position. This whole concept of whether or not a local government gained authority from the Wayfair decision in 2018 is still, no court has ruled on that. But so we don't know whether or not it's, what the Supreme Court said flows all the way down to the local governments when there is no intervening state. It's pretty easy when the Supreme Court was very clear that the obligation to collect the local tax was included when you collect the state tax. When you collect the state tax, there's not been a court case on whether or not that concept applies to local taxes when there's no state tax. But it is the position of the local governments in Alaska that if you meet the threshold in the state, you've met the threshold everywhere in the state. Now,
okay.
Remember the disclaimer at the beginning of this. This is not tax advice. Call your CPA, call your tax attorney, talk to somebody that can really look at Alaska law and look at your facts.
Yep. All right. Thank you for that. Let's go ahead and take a look at our poll results. So if you haven't gotten your responses in yet, go ahead and do that now. We're closing the slide in 3, 2, 1. All right. So it looks like people a little less than 50%, or a little over 50%, sorry, are saying that they have not had to change their financial processes to account for tax changes, but over 31% said they have. And that's just in 2024. So interesting call out. Thank you everyone for responding to these poll questions. All right, let's move forward. And Scott, I'm going to pass it back over to you. We're going to zoom out and take a look at worldwide taxation and e-invoicing.
Okay, thank you. This is a concept that exists in the United States in a theoretical environment. E-invoicing is exactly what it sounds like. It's an electronic invoice. It's a digital invoice. And these are concepts that have developed around the rest of the world based upon the incidents of fraud that exist in the tax structure around the world. Value-added taxes have a peculiarity in them that lends itself to not more fraud, but a way to be fraudulent that doesn't necessarily exist in the sales tax world. And so for a long time, governments around the world, especially started in South America, have came to the conclusion that the way they were going to dampen the ability for people to commit fraud was to have more regulation over the transaction. And it's taken a variety of different forms around the world. E-invoicing is the form. In that format, the government creates an invoice, and it's a digital invoice. It's not intended to be viewed by a person. You have to translate it into something else if you want to look at it like you would normally look at a paper invoice. But the point of this invoice is to make sure that every invoice that goes between trading partners, whether it's a business-to-business transaction or a business-to-consumer transaction, or business-to-government transaction, that the invoice look exactly like the last invoice and every other invoice. So that the data is all in the same format. It's all in the same spots, to make it very simple for the government software to evaluate the invoice. So you start off with this concept: we're going to create a digital invoice, and then we're going to eventually force everybody to use this invoice when they're conducting business inside this country. And then we're going to force you to share that with us. You could do it like they do in Brazil, which is the transaction has to be approved by the government before you can make the transaction. It's all the government's inside the transaction. And that's not an unusual concept. I mean, the government's been talking about being part of every transaction for a long time. They've just never had the technological capacity to do it, and or the will to actually require the law. So what is happening is that all these people are doing, all these governments are enacting outside the United States, obviously, are enacting these e-invoice requirements and then slowly moving into the mandates. They're not, unfortunately, they're not all taking the same format. Some, like Brazil, which is an unusual one, they want to be part of the transaction. Others, you send your invoice into the government approves the invoice, but they're not really part of the transaction. They send you back an invoice that has a government watermark on it. Some, it's an after the fact reporting requirement. And so it's going to take a lot of different forms around the world, and it's still slowly making its way into every country. But we certainly believe that the e-invoicing will be a mandate, and there will be some sort of sharing with the government at some stage in the transaction requirement in every country where there's a value-added tax. Where this is happening, what this means to you is if you're engaged in business outside the United States, you should expect to have to do these things outside the United States. So your transactions, your invoicing system you should be thinking, your accounts payable people, your accounts receivable people should be thinking about what an e-invoice looks like and be looking at the different software packages that exist today. Because at some point in time, if you're doing business outside the United States, you're going to run across this, and one of your business trading partners is going to expect you to do it the way the government wants it done in that country. In the United States, there is I would call it a pilot project, but the Federal Reserve has been trying for some time now to reduce the cost of doing business. And they do so from an invoice perspective. So they've got this project going on where they're trying to make, they've created an e-invoicing standard, and they're encouraging businesses to use this e-invoicing standard, not because it's a mandate imposed on anybody by the government, simply because it makes transacting business simpler. It's all going to be done through a computer. It'll be quicker. It'll be less susceptible to, those of us that type with fat fingers, and it should go much quicker. At the same time, they're also trying to take advantage of the technology that exists today in Zelle and Venmo and things like that to allow you and I to move money to each other quicker and less expensively. Now, all of this should be a really good thing at some point in time. I don't expect it to ever be a mandate in the United States, certainly not for sales tax purposes. The federal government has no incentive to mandate this, and it's questionable whether or not they even have the constitutional authority to do it. And states, while a state could mandate this, it gets really, really complicated very quickly, and whether or not they actually have the authority to do it. So let's go to the next poll, Courtney.
Let's do that. Let me fast forward to the actual poll question itself. There we go. So this is our last poll question, and we are right at the top of the hour. So we'll leave this up for a few minutes, but we have had a lot of questions that have come in. I think right now we're at 150, over 150. So obviously we are not going to be able to get through all of these. But we will dive into as many of them as we can over the next few minutes here. So let me take a look at some of the most recent ones. I saw a question that came in about, this is going back to Colorado's retail delivery fee. So according to Colorado, they have a kind of an exception, if you will, for businesses with less than $500,000 in sales during the previous year. If a business is under that, people are asking, does that mean that they don't have to collect the retail delivery fee there? Audra, Scott, any thoughts?
Oh, I'm sorry. I thought Audra was going to answer, so I wasn't listening.
Oh.
Pardon me.
No worries. People were asking about the exception for Colorado. So they say that there is an exception for businesses that make less than 500,000.
Yes. So thank you. And I think, to be generous, I think we all appreciate that the legislature thought they were trying to make things simpler for small retailers. So they have this. So there's what they did though is they've created two forms of economic nexus, and Minnesota did the same thing. So there's two forms of economic nexus for the retail delivery fees. One to actually collect the sales tax in the first place, and then one for having to collect the retail delivery fee. Now they're not the same. If they were the same, that would be at least one less thing you have to remember. But there's a high the threshold to collect sales tax is $100,000, and then but the threshold to have to collect the retail delivery fee is higher in both Minnesota and in Colorado. Now, one thing we didn't talk about in Minnesota, which makes it is the reverse of that their attempt at simplicity, is that Minnesota, it doesn't tax clothing, but Minnesota expects you to collect the retail delivery fee when you ship clothing into Minnesota. So even though you don't have a sales tax license, because Minnesota doesn't tax clothing and all you sell is clothing, you have to collect the retail delivery fee if you exceed that, whatever that threshold is. And so you may end up having a sales tax license anyway, simply to report the retail delivery fee.
Got it. Okay, and I saw another question saying that they're under that $500,000 threshold, but it sounds like they had started collecting retail delivery fees, but didn't realize that they were under that. Should they continue doing so, or does that depend on the scenario?
That's tax advice. They should.
Can't do it.
We'd be happy to refer them to a local Colorado lawyer or accountant who could help them work through those kind of questions.
All right, let's see. Another one on retail delivery fees. Do they apply to Amazon sales? Do you know?
Yes, they do. They do indeed. But if you sell via a marketplace, Amazon, eBay, Walmart, the law applies to them. Each Colorado, Minnesota have what's called a marketplace facilitator law, and in those under that law, the marketplace is the tax collector, and they have the obligation to collect the sales tax. They have the obligation to collect the retail delivery fee as well.
Got it. And one more on retail delivery.
And we all know that whatever economic nexus threshold or retail delivery fee economic nexus threshold either state has, the big marketplaces exceed that and will be collecting the retail, or if not collecting or remitting at the very least.
Yeah. Okay. Let's do one more on retail delivery fees, and then we can move on. If a transaction is exempt as a resale, does the retail delivery fee still apply?
Not from what I've read. So no, let me answer that differently. For a transaction to be subject to the retail delivery fee in either Colorado or Minnesota, there has to be sales tax collected on the invoice. Okay. If there's something on the invoice that is subject to the state tax only in Colorado, not the local tax, the state tax only, then the retail delivery fee applies to the invoice. If there's nothing on the invoice that's subject to state tax, then there is no invoice, except in Minnesota, or no for retail delivery, except in Minnesota, where Minnesota added exempt clothing into the tax base for the retail delivery fee. So even though there's no sales tax collected on the invoice because it's clothing, it's still subject to the retail delivery fee. So the two states are quite different in this perspective. Colorado, there has to be a state sales tax collected on the invoice before the invoice. And remember, this is retail delivery fees are invoice based. So it's 50 cents an invoice. It's 29 cents an invoice. It's not 29 cents a product or 50 cents a product. It's invoice based. Whereas the sales tax is product based.
Okay. All right, thank you. I saw another question, a couple of questions that popped in about e-invoicing, but as it relates to Canada, have either of you heard anything about Canada mandating e-invoicing?
I haven't.
No, and again, that's where I get spoiled and go to our VAT team and get updates from them. So I do not know off the top of my head, sorry.
No, and I haven't heard anything on that either, so maybe not yet. All right, let's take a look at some of the other questions that we have here. One in regards to Alaska. So does Alaska have one single tax rate, or does each municipality have their own? Do either of you know?
They each have their own.
Okay.
And the rate can vary seasonally also.
Yeah. So, and they have holidays.
Yeah. So it's Alaska's complex. Yeah.
It's very complex.
Some of the jurisdictions don't even have their own website. So, it's one of those things where central administration is good if, you get consistency. But yeah, then if that pulls in everyone, then it could be bad. But yeah, they don't even all have websites. And like I said, for the months where tourism is higher in Alaska, the rates are higher. And so, April to this, it's one rate. So it's not simple, but when you're doing Alaska research, going to the websites can be beautiful. It makes you want to visit there.
Yes. And there are still a number of local governments in Alaska that are not members of the Remote Sellers Commission. And you really need to be looking at your facts and get some really good Alaska specific advice, because you could be making sales into Alaska and not have to collect a local tax because they're not part of the Remote Seller Commission. But then again, get really good advice on Alaska.
Yeah.
And if you're trying to contact the jurisdiction themselves, start early, because they're usually only open a few hours a week. I may not get back to you quickly.
Got it. All right. I think, Audra, this might be a question for you related to streaming. So this person says, will streaming service taxes be required to be identified separately on an invoice? Do you have any ideas on that one?
So it's going to depend on which tax the streaming services are subject to. So, for example, in the states where it's deemed subject to the sales tax, it could be in that same line as anything else subject to sales tax on your invoice. Florida, the communication services tax would be a separate line item, or your amusement tax in Chicago. Your utility user taxes or video users taxes in California would be a separate line item. So it's going to depend on which tax the services are subject to.
Okay, noted.
Yeah, there are taxes, especially in the telecom area, where I can think of one in South Dakota, and I think maybe the big tax that's in court in Connecticut, where you're not allowed to put it on the invoice because it's a tax on you, the company, and not the consumer. But so it's this. You need to be very careful when you need to make sure you look at those laws very, very carefully to decide before you start putting things on invoices or not putting things on invoices. There's a number of states where the sales tax is required by law to be separately listed.
Yeah, and to your point, you look at your phone bill and there's a lot of taxes and fees on there. The states generally require, and the Federal Communications Commission actually has a truth in billing requirements. So if a tax or fee is imposed on a company and they choose to recover it to you as part of the agreements in the subscriber agreement that authorize them to do so, or the state law that also authorizes them to do so, those generally have to be identified in a separate section of the invoice from those taxes or fees that are required to be collected from a subscriber. So, one thing to try and help consumers decipher their invoices. Then oftentimes those taxes or fees that are chosen to be recovered will go back into the sales tax base. That's often referred to as tax on tax, because that's an expense of doing business that they're recovering from the customer, and that's viewed as income. So if you've ever tried to figure out, what items are subject to tax on your invoice and get to the right rate, sometimes you need to get down into that taxes and fees section, because oftentimes those are considered part of the tax base as well, and they're included in there. And that can require billing system upgrades too, to do those circular taxes to figure a tax on a tax.
Yeah, it's there. One of the questions that we had was whether or not there's a list of gross receipts taxes, and I directed the person to the tax foundation because they do really good reporting. But it's a function of how you define gross receipts tax. South Dakota sales tax is based on gross receipts. They call it a gross receipts tax, but it's not at all like the Hawaii gross receipts tax. Nothing like it at all. And it's nothing like at all like the contractor's excise tax in South Dakota, which is a real gross receipts tax, because to Audrey's point, the contractor's excise tax in South Dakota applies to the tax. So you calculate this 2% contractor's excise tax, times the total value of the contract plus the tax. So you got to figure out, you got to get your math ready and get your calculator out so you can calculate the contractor's excise tax on the contractor's excise tax you put on the invoice. So somebody asked a question on our experience with how investigative state tax departments are. Audrey and I have looked at this thing from two entirely different perspectives. Her as a practitioner helping people, and me as the guy who ran the state tax department for 10 years. But one thing I will tell you about the internet's changed everything in the tax department as well. So artificial intelligence, machine learning, all those things are being incorporated into audit selection processes, and there's a whole list of private companies that gather data for departments of revenue. And so you go to a state tax conference, and you go to the Federation Tax Administrators Technology Conference, and you'll see a room full of vendors, and they're there to sell services to states, and a lot of those services are about finding you.
Yeah, and I guess on that note, also, one of their first points of investigation is to look at your website. So make sure you've looked at your company's website. What does the website say you're doing? Does it accurately reflect, your understanding from a tax department personnel of what the business is? Are there some words on there that are more for marketing purposes that might suggest you're doing things other than what you are? You know, uh, is it enhanced to make it look like you're providing communication services when you're really not? Because once a taxing jurisdiction looks at your website, finds those keywords and those buzzwords, you trying to prove that you're doing something other than what your marketing people said you are is an uphill battle. So you know, they start with what's exterior facing, your marketing materials sent in the mail, your website. So make sure you know what those are saying and make sure it accurately, you know, reflects your understanding and how you've treated it, you know, from a sales tax purpose. Because you know, that's the first place they're going to start.
And they
That's
talk
really
to each
interesting.
other. They share information. So, yeah, it's easy to avoid them, but it's bad news if they find you.
Yep, for sure.
There is no statute for most states. There's no statute of limitations. Most states, not every state. There's no statute of limitations or how far they can look back if you don't have a license.
Oh, interesting. Okay. I know we talked about this. This is going back. We've gotten a lot, as expected, we have a lot of questions about retail delivery fees. But one more going back to that. We discussed, obviously, that Colorado and Minnesota have one, but this person is asking for clarification on which states are considering a retail delivery fee. And I think there are at least 6 that we talked about. Are there any that you would kind of call out as maybe the one to keep an eye on?
I think Washington would be the one that I'd look at first. They commissioned a study. They put a lot of effort into understanding their highway construction needs and what a retail delivery fee would do to help them pay for that. There's legislation been introduced in Ohio and New York and, you know, in a couple other states. You know, certainly in Ohio and New York, nothing has been enacted, although the New York legislature is still in session. They could certainly do something before the end of the year. But Washington would be the first one I'd look at.
Yep.
Yeah, and if you kind of want, you know, input as to what they're thinking, definitely look for that. The study is published, and like I said, it's very informational. Gives a lot of input, and again, I wish that states would study other taxes that they implement that are bigger and have more impact to consumers or businesses before they implement them, as they have done that retail delivery fee in Washington. And you know, I think reading that study also really showed me what could be coming from the digital services taxes or any of your digital advertising taxes. If a jurisdiction passes one that complies with the Internet Tax Freedom Act, the Constitution, and things like that, I think you're going to have a lot of states looking at that the same way, you know, all these states have been looking at Minnesota and Colorado as their guide for the retail delivery fee.
Yeah. And just a quick note, we do have a link to that Washington study that Audra and Scott just referenced in the slides themselves. So if you want to download the slides in the additional resources section down at the bottom of the console, there is a link to that. And then we also list out some of the other states that are thinking about it or are considering it as well. Let's maybe go back. We have maybe 10 more minutes for Q&A. I'm not sure if we'll take all of it. Like I said, we have gotten a lot of questions, but many of them are a little too specific. We're not able to go into specifics. Like we said, that falls under legal tax advice. But this one is kind of going back to the basics of economic nexus. So it sounds like this person's business, they did meet the threshold. They registered, started filing their sales tax, but it sounds like they no longer meet the threshold. Is there a timeline where they can withdraw or stop filing?
You know, that's a great question. If you don't have nexus, regardless of how you achieved that nexus in the first place, whether you had a store there that you closed, you had employees there that don't work there anymore, you made sales in excess of $100,000, or you had more than 200 transactions. In each of those cases, there's a legal presumption that if you no longer meet the state's requirement to collect tax, you don't have to collect tax. There's a concept known as trailing nexus that doesn't get talked about enough. And trailing nexus is this presumption that what you were doing in the state created that at one point in time you did something inside that state that created a marker for you inside that state, and even though you've stopped doing that, you still have a market inside that state. I don't know how that works now with economic nexus. Maybe Audra maybe you guys at KPMG have thought about this, but I think there used to be a presumption that you collect sales tax for X amount of months after you stopped having physical presence nexus, but not even every state followed that rule, and they all had different time thresholds. But I don't know how it works now with economic nexus. I'll just start. I'm going to leave it at this: if you don't have nexus, you shouldn't have an obligation to collect the tax. That's the point of nexus. Now, how long that goes are state specific and fact specific.
Yeah, that's what I was going to say. It's really a state-by-state question. Unfortunately, that's the common answer here, but it really is. And, I also think, too, you'll want to look at do you think that elimination of nexus is permanent, or is it a dip in time? Because obviously, filing, then not filing, and things like that can be just as complex. So, I think there's a lot of business factors that would weigh in, and then take those facts, accumulate those facts. Did you just, have one big customer in the state, you don't have them anymore, and you don't expect to get more, get all those facts and then go look at the specific rules of the state. Because I think, it's going to care about all those types of things. I think a temporary dip, is not something you're going to want to change your practices over. So, really get all the facts you can surrounding, the circumstances that caused the nexus to go down.
No, and that's a great point. If you sell something that's very expensive, so a single sale puts you over an economic nexus threshold, or you sell something that requires you to be physically present, that truly may be something you do once. In that situation, you should give serious thought to, whether or not you expect to do more business again, or whether it's worth the effort. Because states, if you're filing zero sales tax returns, states don't like zero sales tax returns. And eventually, if you file zero sales tax returns in a state long enough, they will cancel your license because they don't want the heartache. It's just too much effort for them.
Yeah.
No, there's a question. Will Avalara alert us we no longer need the threshold? I don't think we do.
Sorry, can you repeat the question one more time, Scott?
So there was a question. One of the questions: will Avalara alert them if they no longer meet the threshold for nexus? And I don't think that's what our heat map does.
No, it does the opposite.
It does the opposite. Yeah.
Yeah. Yeah. So if you're an Avalara customer,
we're not, it's not our business to tell you when to stop collecting tax.
Yeah.
So that's.
I was just going to note, if you're an Avalara customer, there is a heat map once you log in that will show you where you may be close to triggering nexus or where you've already triggered it. But to Scott's point, I don't think it does the opposite, and it tells you when you have stopped triggering nexus. All right. Well, we have just a few minutes left. I don't want to open a can of worms, but I did notice a couple of questions that came in on Illinois, and there were some recent updates that went into effect with sourcing rules. Is there a quick abbreviated version of what's going on there?
Audra, you have a thought on that one?
No quick abbreviated version.
I think it could be a topic for a webinar in and of itself.
It is.
Yeah.
But I think I feel obligated to make a statement. What they've tried to do, Illinois is special. Um, the when the legislature adopted economic nexus, they made they if you want to have a really good laugh, and I'm not criticizing the Department of Revenue in Illinois, because they have extremely complicated laws, and I think they did a wonderful job trying to use a picture to describe nexus in Illinois. It's an origin sourcing state, which means that historically you collected tax. I'm not going to use the word sales tax because they don't use the word sales tax. You collected tax based upon where you shipped from, regardless of where you were shipping in Illinois. Well, when they adopted economic nexus, they had to think of a way. And so if you were not in Illinois, you never collected any tax at all. So with economic nexus, they needed a way to get the folks who weren't in Illinois to collect tax. And so they went with destination sourcing for people who had no physical presence whatsoever in Illinois. So if you're an in-state retailer, you will collect one rate. If you're not a state retailer, you may collect every rate. They're being sued. There's a half a dozen lawsuits going on right now because of what's inherent in that distinction, which is one person has much less thought they have to give into how much tax they have to collect. The other person has a lot of thought they have to get into, and then there's the differences in rates. You're competing with somebody that charges a rate that's lower than the rate that you may have to charge in another jurisdiction. So that either of you would. So this year they changed the law to try to eliminate some of the disparity in the sizes of the groups. So and this is where I'm going to direct you to go to the Illinois Department of Revenue's website to look at their instructions, because there's a group of businesses, and a fairly large group. It's nearly 20,000, as I understand, businesses around the world who are going to have their nexus changed on January 1. And we have been working with the Illinois Department of Revenue. We have several thousand of Avalara customers who meet the state's definition of someone who is supposed to start charging the destination-based sales tax. So on January 1, all of those customers that meet that state's definition, who are Avalara customers, are going to have their nexus changed. That's what the law is. And we're working with the department very, very carefully and almost daily to make sure that we understand who in the heck is impacted, because we don't want anyone's nexus to be changed that isn't legally required to be changed. So please go out to the Department of Revenue, Illinois Department of Revenue's website. They've got a really good document out there that explains all of this. We should have put it in our presentation, and I apologize for that. Maybe we can figure out a way of getting that to everyone. But there's changes coming, and it doesn't impact everybody, but it impacts a lot of people.
Yep. All right. Well, thank you, Scott, for that breakdown. And thank you, Audra, too, for being here and sharing all of your wonderful knowledge. That is all of the time that we have for questions. Just a few final reminders for the folks that are still with us. So obviously, if you met the requirements for CPE, you should be able to download your individual certificate in that Earn Certification box. We also will include a link in the follow-up email that includes the recording for your individual certificate as well. So no worries if you forget to download it today, you will have access to that after the fact. And then, like Scott was saying, we do go into a lot of depth around all of the topics that we covered today, including Illinois and the sourcing rules in our Avalara Tax Changes 2025 report. As a webinar attendee, you are going to be receiving early access to that written report. So keep an eye on your email inboxes for your advanced copy. That could be coming as soon as tomorrow morning. And like I said, it goes into a lot more detail about all of the topics that we covered today and many, many more. So be sure to use that as your guide. And again, Scott and Audra, always a pleasure. It was great to have you both on here sharing so much of your knowledge. So I appreciate your time and attention today. This was super valuable. And I'm seeing a lot of reactions from attendees that are saying the same. So thank you very much.
Thank you, Audra.
Right.
We appreciate you. And thank you for joining us.
Happy to join you. Thanks for the invite.
Yep. All right, everyone. Well, we'll see you for one of our future webinars very soon. In the meantime, Happy New Year and happy taxing.
Thank you. Bye-bye.
Bye.